Medicare's IRMAA is one of the more complex costs to tax plan for in retirement. Because of this, I see a lot of mistakes and issues arise when factoring it into Roth conversion strategies and other tax planning. In today's video, I'm going to give you a blueprint for how to factor IRMAA correctly into your conversion strategy. For those that don't know what IRMAA is, when you show too much income in retirement, the government basically feels that you can afford to share in more of your Medicare costs. So if you hit certain income thresholds, you will be subject to this IRMAA penalty and see both your Part B and Part D portions of Medicare rise in costs. Now here's where IRMAA can get a little complex. It's based on a 2-year look back, so the income that you show this year in 2025 will affect what you pay for Medicare in 2027. If you are subject to these higher costs, know that it only lasts for 1 year. So if you are subject in 2027, you may not be subject again in 2028 unless your 2026 income was also high. But this also means that you need to start worrying about IRMAA in the year that you turn 63. IRMAA is also a tax cliff, where if you show $1 over a threshold zone, you will have the full penalty for that threshold. Then IRMAA is based off something called your modified adjusted gross income, where muni bond interest is added into your income and you aren't allowed to take the normal standard deduction. Now here's a snapshot for what the IRMAA tables look like here in 2025. But remember, 2025 numbers are based on 2023 income, which is already set in stone. Really for 2025, we care about the 2027 IRMAA brackets, which at this point are unknown. These tables adjust to inflation, but we don't yet know what inflation will be to know exactly what the 2027 tables will look like. This is another tough area of IRMAA planning. At the end of this video, I'll link to a video that shows how to accurately calculate out future IRMAA zones. But as you can see from the table, there are multiple threshold zones an individual could be subject to, with each zone costing a retiree $1,000 to $1,500. Depending on the composition of your income, the first threshold zone typically begins around the top of the 22% bracket. And everything here just doubles for married filers. Now, to wrangle IRMAA and plan correctly around it for Roth conversions, we first need to start with something we call a forward-looking tax plan. This means we need to have some kind of accurate way to forecast what our tax liabilities will be in the future if we don't do any tax planning and just use a default withdrawal strategy, like let's say taking from your taxable account first, pre-tax account second, and Roth accounts last. Now, here are a couple things I like to look at inside of a forward-looking tax plan. I'm only going to include a couple charts for the sake of time, but know that this process is a bit more thorough than just looking at 1 or 2 charts. First, I like to look at the top marginal tax bracket a retiree is estimated to be subject to in each year. For instance, this is a retiree where one spouse will need to begin RMDs in 2026. They happen to have the majority of assets. The other spouse, however, is quite a few years younger. As soon as RMDs begin, this couple's top marginal bracket is 28% for a good decade plus. And then eventually, when the older spouse passes, the surviving spouse will see much higher taxes at 35%. As a review, RMDs, or required minimum distributions, are forced withdrawals from pre-tax accounts. This person is going to be forced to take out more money than they need to, which catapults them into higher tax brackets. So just from this one chart, we know that Roth conversions can be beneficial and can be used to lower RMDs to save on taxes. Initially, we know that if we can convert at rates lower than 35% and avoid that tax bracket entirely, conversions will be beneficial. Then if we can convert at lower rates and avoid the 32 and 28% bracket, this too will be beneficial. With the second chart I'm showing, I like to see the composition of where the tax is coming from. Here we have normal ordinary income tax, we have state tax, but then you'll also notice we have quite a few IRMAA expenses owed each year once RMDs begin. This chart can give you a clue into when and where we are paying certain taxes to either try to avoid or shift. In general, the goal of forward-looking tax planning is to give us an idea about what tax rate we are comfortable paying to Roth convert today certain portions of our pre-tax accounts. For instance, if we are comfortable converting at a rate of 30% or less, we know that we can only be so aggressive with our conversion. We can't, for instance, convert at 32% because conversions no longer make sense in that scenario. We are paying too high of a tax rate. As I've talked about in other videos, Roth conversion math really comes down to the tax rates you pay and the tax rates you avoid. As we've already indicated, IRMAA can come with its difficulties. First, the 2-year look back is quite confusing for most people. Again, you can't just look at the 2025 IRMAA tables and base your decisions off that table, because 2 years from now, those thresholds and costs in the table will rise due to inflation. But even if we can't accurately get down to the penny, we can get very close to predicting future tables. Click on the video in the upper right hand corner to learn more. But the other difficulty is I find most people don't know how to handle a dollarized expense. For instance, that Eric guy from Safeguard always talks about Roth conversion math coming down to tax rates. Well, IRMAA is a $1,000 expense. What am I supposed to do with that when it comes to rates? Well, let me show you in a second, but I first want to cover a common mistake that I see. Say you are married and subject to the first IRMAA zone in a given year. I'm just going to use the 2025 tables for an easy explanation here. Say your modified adjusted gross income was $215,000. Many look at an IRMAA penalty in an effective tax rate type lens. $2,000 in extra cost isn't a big deal because it's such a small percentage of the $215,000. So why even worry about IRMAA? Remember that IRMAA is a tax cliff. So you weren't subject to IRMAA based on $215,000 of income. You were subject to IRMAA because of the $3,000 over a threshold zone. If we can avoid taking that extra $3,000, we avoid $2,000 in extra costs entirely. Let me show you what I mean with an individual's example with more accurate numbers. So for the sake of projecting out IRMAA tables, we're going to assume 2% inflation, which means the first IRMAA threshold zone for an individual for 2027 tables is $110,000. So if 2025 modified adjusted gross income, or MAGI, is over $110,000, this person will owe extra for Medicare. Well, due to a reasonable RMD and their other income, this individual is estimated to end the year at $118,000 of MAGI. Even though IRMAA is a dollarized expense, we can easily translate it into a marginal rate add-on. At $118,000, the added cost of IRMAA is quite high. The extra $8,000 of income is what forces this retiree to owe extra costs in the first place. So when we take $1,092 of added IRMAA expenses and divide it by $8,000, this gives us a 13.5% add-on rate. This person lives in Colorado, and we're taxed 22% at the federal level and 4.4% at the state level for withdrawing this extra $8,000. In total, the marginal rate on the last $8,000 was quite high at just over 40%. This retiree would not want to end the year here. Now, it's the RMD that forces us into this zone, and we can't really decide to not take that RMD. But based on this math, we have a few options. Option number one, give $8,000 of that RMD to charity through a QCD if you're charitably minded. When giving to charity, it's generally best to maximize the tax benefit from that giving. Well, if you're only going to get 60 cents on the dollar for this extra $8,000, you might decide to just give it to charity instead. Option number two would be to perform an additional Roth conversion. This would be beneficial for a couple reasons. Number one, we spread out the impact of this IRMAA cost. Because we already fell off the cliff, we're just going to owe tax costs on any additional conversions, assuming that we don't push into the next IRMAA zone. Number two, by Roth converting today, we minimize future RMDs. Maybe this can help us avoid future IRMAA thresholds, or at least help us avoid being pushed into additional zones in the future. Like I said before, we can fill up this entire zone and we owe the same Medicare costs either way. Well, this allows for another $20,000 in conversions. In spreading out that IRMAA cost over more income, we drastically lower the tax cost of that Medicare penalty. We can take the same logic and calculation and then calculate out the marginal cost for hitting each IRMAA zone, assuming we use the full zone of any zone that we hit. On the screen, I have a breakdown for what this looks like. This is important as you look at the forward-looking tax plan here as well. If in the future you're subject to a threshold zone and you have an IRMAA penalty, we can add together the federal and state tax rate we would be paying in that zone and then also add in the IRMAA tax rate on top of this. This gives us a clear level to inform decisions today. Say in that forward-looking tax plan, we see that RMDs push us up into the second threshold zone. Here we are paying a tax rate of 24% for federal taxes and 4.4% for state taxes. Using the full zone here means we have an add-on rate of 4.68% for IRMAA, giving us a total marginal rate of 33%. Now that we have this projection, we can use that higher rate in the future and look at our Roth conversion. If we can pay lower rates today and convert to Roth and avoid this zone completely, we should. If we can't convert at rates lower than this, then we are better off just taking the future IRMAA penalty. So this type of calculation can help us out both right now in deciding if you should convert into an IRMAA zone or in the future in assessing what rates and hurdles you want to avoid. A general principle here is that it almost never makes sense to end up in the middle of an IRMAA zone. And this is entirely because IRMAA is a tax cliff. You will want to manage your situation in a way where you end up either avoiding IRMAA completely or you end up as close as possible to the next threshold zone without going over it. Ending up $1,000 or $10,000 in the middle of a zone means you're paying a pretty high marginal cost on that Medicare penalty. Here are a couple things you want to keep in mind as you are working through this process. Number one, an IRMAA penalty you decide to take is generally preferred over one you are forced into. What do I mean? Some retirees might find themselves Roth converting into IRMAA by choice. Most of the time this is done because it is more beneficial to take one or a few penalties in your 60s rather than see RMDs later in life force you into IRMAA. Once RMDs are forcing you into IRMAA, it's a very difficult train to stop, and you have a lot less ability to fix issues. To fix issues, that means small conversions or needing to convert into additional IRMAA zones. Number 2, as we've already mentioned, when you look at your forward-looking tax plan, make sure you are adding in the additional tax costs of IRMAA as you are projecting out those future tax rates. You might think RMDs are just pushing you into the 28% tax bracket in the future, but in reality, the future tax rate paid will be higher after factoring in IRMAA's additional costs. Number 3, make sure you are correctly factoring in inflation into IRMAA tables. If you use current tables and think the top of a given zone is $133,000, after factoring in inflation, you might find that in reality, the zone would actually have been $138,000. Due to this miscalculation, you gave up $5,000 of extra room to fill that zone. This means you paid a higher IRMAA cost as a percentage. And finally, don't forget that IRMAA is a tax cliff. There aren't many tax cliffs in the tax code, but this is one of them. Now, if you like this video and want to learn more about managing IRMAA correctly, you need to understand how IRMAA adjusts to inflation. Click on this video right here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.